Yes, sir, you are totally visible.
Yeah, thank you. Two minutes.
Sure, sir.
Yeah. Yeah. Prerna Bhatt is there, Devanshi is there, Khushbu Trivedi is there, Parth Joshi, Preeti Patel, and Vivek Rana. These are the students we have today. Dear students, good morning, and let us start with the SFM. I have got some plan on mind. However, before I start with my own plan, just I would like to know from you, if at all you have any specific expectation, then we will address that first. And if not, then in that case, whatever the planning which I have made, with that, so we can start. Yeah, anybody having any special expectation or special request? Rena, Devanshi, Khushbu, Parth Joshi, Preeti Patel, and Vivek Rana. Just you can use the chat box to answer. No special request, Devanshi. Thank you, beta. Others? Okay. Others? Okay. Yeah. Thank you. So, what I have thought is something like this. Yeah. Yes. 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 Thank you, Parth. Yeah. Good morning. Swap ratio. Rena but has a point that said, kindly cover a point of swap ratio. Sure, my dear. Before I proceed further, just would like to tell you one thing, which I always feel, that the life is all about the challenges that we have, and especially right now we are going through the challenge of COVID-19, and I'm sure that's considering the number of cases in your family, maybe you or like surrounding to you, there will be number of cases. However, we don't have to lose our focus, and our focus is say passing our examination with good preparation. So make sure that say whatever may be certain these kind of uh, a few things which are not in our control, we overcome them and we focus properly on our studies. Dear students, first of all, I have planned to cover November 20 suggested answer. I would like to discuss with you that's the questions which have been asked. Fortunately, at this point of time, we have also the suggested answers. So we can start with the directly suggested answer understanding. I would like to discuss with you a few important points over here, and I think that's the general review, and even I admit that that's the general review was that's an examination paper was difficult. Even I agree with that partially. Then in that case, say just let us have a review about the same. The question number 1A, that was from the chapter of foreign exchange risk management. I'm sorry, before proceeding further, one more point that I would like to discuss with you is that do not keep in your mind that say whatever has been asked in the recent examination that will not be repeated. Ignore that point from your mind. Maybe the same concept can be asked once again in examination. The question number 1A, first from the chapter of foreign exchange risk management. I just tell you that say what is the question about? The question about that whether to enter into forward contract or not. It is as simple as that. We have been provided two things. One is the forward exchange rate and another is the different probabilities have been given to us regarding the spot exchange rate that we are predicting. Based on the probability and that is the spot exchange rate which we are expecting to prevail, we'll compute the expected spot exchange rate, and once we compute the expected spot exchange rate, it will be compared with the forward exchange rate in order to decide whether to enter into the forward contract or not. It is as simple as that. There are two additional points over here. One point is we have been provided with the information about the upfront premium that you have to pay, and since it is upfront premium, so we have to compute that say what would be the interest cost for the premium that we pay. I already have shared this material with all of you, and I think that's the Vikasa team members must have forwarded that to you. I'm reading it. If at all you have any query or doubt, then in that case, definitely you can post in the chat box. We'll discuss it. ZX Limited has made a purchase worth $80,000 on 1st of May 2020, your favorite date, which it has to make payment on 1st of November. So on 1st of May, you have made purchase, and on 1st of November, you have to make the payment. The amount of the consideration that you have to pay is $80,000. The present exchange rate information is irrelevant because you have to decide about the entering into the forward contract. The company can purchase the forward dollar at the rate of 74. So if at all we are going for the forward contract, then in that case at the rate of 74 it will be purchased. The company will have to make upfront premium at the rate of 1% of the forward amount purchased. So 74 is the rate at which you can buy the dollar, and 74 into 1%. That is 74 paise is the amount of the premium which is required to be paid upfront. The cost of the funds to ZX Limited is 10% per annum. So importantly, what happens at say if at all we are entering into the forward contract, then 74 rupees is what we have to pay at the end of the 6 months, and 74 paise is required to be paid right now. the amount that you're required to pay right now, for that, see, we will have the opportunity cost of 0.037. 0.037. This is the interest cost and this is the premium cost. Sorry, the kind of transaction cost that you have to pay. 74 plus 0.74 plus 0.037. That comes to 74.777 rupees per dollar. This is the rate at which you can purchase the dollar. That is what we understand. The company can hedge its position with the following expected rate of US dollar in foreign exchange market. Now, this is the point where I would honestly admit that a student may have a confusion. See, the word that they have used over here is that the company can hedge. The company, if the company is not hedging, that should be the language of the question. Yet, let us see, understanding logically that these are the expected spot exchange rate on 1st of November. The probability is given and exchange rate is given. So there are 15% chances the rate would be 77. So 11 rupee 55 paise. 25% chances it will be 71. So 17 rupees 75 paise. 20% chances it will be 79. So 15.8. 40% chances it will be 74. So 29.6. So the total of all of them is 74.70. So if I told the forward contract is not entered upon, this is the rate at which you will be able to purchase the dollar. And in case of the forward contract, the exchange rate effectively is 74.777. So of course, entering into the forward contract is expensive. So we should not enter into the forward contract. That is what we understand. Just give a thumb to me that say everybody is with me. Just give a thumb that you have understood. Yeah, thank you very much. Thank you. Okay, thank you. Friends, honestly, from my end, I believe that say, as a student, we should be able to get the full marks. Why do I tell like this? The reason for that is very much similar to this question. The institute has already provided in its material. Nowhere that is you don't have to search anywhere else. It is provided by the institute in its own material. So I think that a student should score full marks in it with no change in the concept. A 2 years tree for the stock of ABC is as follows. So now that is year 0. 1 year later, that is end of year 1. 2 years later, that is end of year 2. So it is 100, 108, 95, 116.64, 102.4, 90.25. So the current price is given, price at the end of the year 1 is given, and based on that, the price at the end of year 2 is given. Logically, we understand that so over here it is 8% appreciation, and over here, so that is 5% appreciation. Always remember, friends, that whatever the price change that we observe in the first period, that itself would be the price change in the second period. So over here again 8% increase, 5% reduction, 8% increase and 5% reduction. Consider 2 years American call option. 2 years American call option. See, the word American is carrying a significance over here that the option can be exercised anytime. Stock of ABC with the exercise price of 98. It is call option? Yes. Exercise price is the price at which you can buy the option. So if at all the spot price is exceeding the exercise price, then in that case you will buy the option. So in that case it is 18.64. 102.6 minus 98. So here it is 4.6. Over here, option is not going to exercise. Why? Because the spot price is less than exercise price. Current price is 100. Need not to give, it has been already provided over there. Rate of interest is 5% per annum with a continuous compounding effect like this. So we have been provided with the information indirectly that say we are required to use the continuous compounding discounting factor. Assume 2 time period of 1 year each. Thank you very much. Using binomial method, calculate the probability of the price moving up and moving down. So friends, in order to compute the answer of the first question, a student can take these prices as base, or these prices as a base, or these prices as a base. One of the three can be taken as a base for doing answer. Every time you will be able to get the same answer. A simple method that I suggest is like this. Probability of the price increase is 1 plus RF minus D upon S whole divided by U minus D upon S. This is a formula to be applied. 1.05127 minus. We understand that's over here. If at all I take the first one, which I feel is very simple. 95 upon 100 divided by 108 minus 95 divided by 100. Simple. This is the way we are required to do answer. So 1.05127 minus 0.95 divided by 0.13. 1.05127 minus 0.95 upon 0.13. So 0.779. So we understand that there are 77.9% of the price increase and the remaining is the probability of the price decrease. That is the way we are required to answer the first question. एक मेरे को थंब चाहिएगा यार, वो वर्चुअल है ना, इसलिए मेरे को लग रहा है कि ये मेरे जैसा तो नहीं है ना स्टूडेंट, वो चालू करके चला गया है. थैंक यू. वो दूसरे स्टूडेंट मेरे को तो थंब दे दीजिए यार. पार्थ से, विवेक से, थैंक यू बेटा, थैंक यू. Now the question says that to compute the expected payoff at N1, N2, N3 and round off up to 2 decimal points. Dear students, I would like to tell you importantly that be very much careful in reading. See, I know that say writing in 2 decimal or 4 decimal does not have any conceptual point, yet the institute is very clear that say whenever they have provided specifically that say you are required to write answer in this number of decimal, then they are expecting the answer in that only. Okay, so over here they are asking about calculation of N1, N2 and N3. Calculation of N3 value is very simple. This, in a way that say we understand, listen carefully, 77.9% chances the price will increase and the payoff will be 4.6. Remaining is the probability of the price decrease and in that case the payoff would be 0 divided by 1.015127. So here 0.779 into 4.6, that is 3.5834 divided by 1.05127. So 3.41. That is the way we are required to make the calculation of answer. This is 3.41. Now for N2 is something which is very important according to me. This is my personal opinion. How it is important? Again, 0.779 is the chances of the price increase, and when price increases, your payoff is 18.64. Remaining is the probability of the price reduction, and even in that case, you will get a payoff of 4.6. Whole divided by 1.05127. 4.6 into 4.6. Sorry. Whole divided by 1.05127. So 0.779 into 18.64, that is 14.52, plus 1 minus 0.779, that is 0.221 into 4.6, that is 1.0166, plus 14.52 divided by 1.05127, that comes to 14.78. Now the story does not end over here. Why it does not end over here? Because friends, what happens at say, it is American option. So the American option can be exercised anytime. So what will happen at this point of time, if at all you want to exercise the option right now, even right now you can exercise the option. And you can see that so the option is in the money. That is, the spot price is exceeding the exercise price. So if at all you exercise right now, your payoff would be 10. And if at all you wait for 1 year, you are expecting to get some higher value. So we understand that say you will wait further and say you will receive the payoff of 14.70. This is an important point. That is, at the end of the first year, you have to make a comparison of the spot price and exercise price. Spot price is exceeding exercise price, then in that case you have to decide whether to exercise your option right now or to exercise it later on. So this is an important point. Once you make these two calculations, the last process is exactly the same. We understand that say 0.779 is the probability of the price increase. In that you will get 14.78 plus 0.221 probability of the price reduction, and in that case you will get an amount of 3.41. Whatever the answer that you get, you will discount further in your zero term, and that is the way you'll be making calculation of the premium. Just give a thumb to me. Okay, thank you. Thank you. I hope that everybody is clear. Parth Joshi, Vivek Rana. Yeah, thank you. C question. Now, I always tell to students like this, listen carefully. This is my personal opinion. Then be prepared to solve the same question that you solve right now of the institute publication with certain extension, with certain modification, or instead of going, that is from 1 to 5, 5 to 1. In a way that's instead of forward, sometimes you have to do backward working. Like that's one of the three kind of calculations that can be done. That kind of question can be asked in examination. And this is that kind of question once again. Usually the kind of questions that we do in examination, in comparison to that over here, we have to do the answer slightly differently. What is that? So let us have a discussion about it. On Tuesday morning, before opening the capital market, an investor, while going through his bank statement, has observed that so the amount of rupees 7 lakhs is lying in his bank account. The amount is available for use from Tuesday till Friday. So it is Tuesday, Wednesday, Thursday, Friday. So 1, 2, 3, 4. So it is available for 4 days. The bank requires minimum balance of rupees 1,000 all the time. So the balance should not fall down before, that is below 1,000. An investor desires to make maximum possible investment where the VAR should not exceed the balance lying in his bank account. The standard deviation of the market price of the security is 1.5% per day. The required confidence level is 99%. Given standard probabilities, you are required to determine the maximum possible investment. Now friends, usually you might have recalled the kind of questions that you have done. Usually the kind of questions that you have done is like this. We make the computation of the standard deviation. Standard deviation is calculated as investment into standard deviation in percentage term. Then we make the computation of calculation of loss for a specific confidence level. So Z is equal to X minus X bar divided by standard deviation. So we make the computation of X minus X bar is Z into standard deviation. And then we make the computation of VAR. How do we make the computation of VAR? It is Z into standard deviation into under root of the time period. This is what we do on the usual basis. That is Z table reading based on the confidence level. This is a question from the chapter of risk management, friends. You must be aware of that. In the risk management, there is only one practical concept that we have. However, that one practical concept have been asked for the third time in examination. Yes, third time. So over here, this is what usually we already have done for number of times. Now the same thing is required to be done wherein some small variation is there. What is the value of the risk? 7 lakhs which is lying in your bank account minus 1000. Because 1000 is the balance that you require every time. Z table reading for confidence level 99%, you should be having, you must remember this, let's say it is 2.33. And for 95% it is 1.65. Remember that. You must recall this to reading because frequently they will ask this in examination. Multiplying with the standard deviation, that is the value of the portfolio into 1.5% into under root of the time period, that is under root of 4. That's it. And we'll calculate the value of the portfolio as balancing figure. So value of the portfolio is 6,99,000 divided by 2.33 into 1.5% into 2. So over here 2.33 into 1.5% into 2. That comes to 0.0699. And the numerator is 6,99,000. And the final answer is 6,99,000 divided by 0.0699. That comes to an amount of 10 million, that is rupees 1 crore. This is the way we are required to make the calculation of answer. Is that clear, all of you? See, the question is so simple only. You can see that the question is so simple. Let's say for this 4 marks of the question, you just have to put this one equation and with that you'll get the answer. Only this one equation. And with that, so the answer is there. Just give a thumb to me if at all you are clear, friends. Clear, all of you? Yes, thank you. Question number 2. I just would like to discuss with you a small point. So before we proceed further, a small point. Suppose a company has, because to discuss that question, I need to have a small explanation to be given. Suppose a company has net profit of rupees 3,60,000. Net profit ratio is 12, that is say 12%. Asset turnover ratio is 2.5 times. And based on this, we are required to make the calculation of the, let us say, return on equity using DuPont model. This is what we are required to calculate. Just a minute. $364 lakhs, I forgot to write. And equity is an amount of rupees 4 lakhs. Suppose we are required to make the calculation. So what you would be discussing after November 20? Could you share the plan for this 4 hours revision lecture? Devanshi has a point that say, sir, what are you going to do after November 20 paper? Devanshi, my plan is say to discuss the January 21 paper. My plan is to discuss the revisionary test paper of May 21 and the derivative forex swap ratio as one of the student requested. All these things that say I want to do. You have any specific requirement, Devanshi beta? Okay. So over here, let us see that say we are required to make the calculation of the return on equity using the DuPont model. Then how to do it? I just explained that to you. Return on equity is found as 3,60,000, that is the net profit, divided by equity financing 4 lakhs into 100. That is the way it is 90%. This is what say we do usually. It is the profit upon equity into 100. However, the DuPont model says like this. Let's say you are required to make the computation of the net profit ratio. That is net profit upon sales. Then asset turnover ratio. That is sales upon assets. And equity multiplier. That is assets upon equity. So basically what happens at the sales is cancelled. Asset is cancelled. And net profit upon equity is the answer. So net profit ratio is given to us in example 12%. Asset turnover ratio is given to us in example 2.5. Into asset upon equity. Equity is provided to us in example 4 lakhs. As far as the asset is concerned, we can make the calculation of asset like this. Net profit ratio is 3,60,000. So net profit is 3,60,000 and NP ratio is 12%. So the amount of the sales would be 3,60,000 divided by 12%. That comes to an amount of 30 lakhs. Sales would be 30 lakhs. Then asset turnover ratio is 2.5. So based on this, we can compute the assets. 30 lakhs upon 2.5, that comes to 12 lakhs. So this is 12 lakhs. So 12% into 2.5 into 3. So the final answer is 2.5 into 3, that is 7.5 into 12%. That comes to 90%. Now this is the concept which was tested in the examination today. That is suggested. Exactly this concept. So over here, the question says something like this. You are required to calculate the sustainable growth rate for both proposals. We have been provided with the information. Let's say from the given information, you are required to calculate the growth rate. I am explaining for the first one. With that, you'll understand the second one automatically. For growth rate, the formula is B into R. B stands for the retention ratio and R stands for the rate of earning. What is retention ratio? 75%. Into what is rate of earning? As I just discussed with you, net profit ratio into asset turnover ratio into equity multiplier, that is assets upon equity. That's it. So 0.75 into what is the net profit margin? 4%. See, we require the asset turnover ratio, that is sales upon asset. But we have been given asset to sales ratio. We require sales to asset, but the question is giving asset to sales. So in that case, what happens? Let's say we are required to do, say 1 divided by 0.65. And we require asset to equity. And you can see that so the target debt equity ratio is given 2:3. So in that case, it is 2 plus 3 upon 3. This is the way we can compute the rate of earning into retention ratio, and that is going to give us the growth rate. Is that clear, all of you? Prerna, Redmi, I do not know. Parth, Vivek. Okay. So that was the way we are required to make the calculation. In my opinion, this was really a tricky question. Why? Because to understand this, like immediately was very difficult. That's why we have to apply the DuPont model. B part of the question is extremely simple. The reason behind that is similar to this. Number of times the questions have already been provided by the institute. IB, an Indian firm, has subsidiary in Japan, and Zeki, a Japanese firm, has subsidiary in India. So Indian company has subsidiary in Japan, and Japanese company is having subsidiary in India. And they face the following interest rate. Zeki wishes to borrow rupee at floating rate. So this company wants to borrow at the floating rate, this. And IB wishes to borrow Japanese yen at fixed rate. So IB wants to borrow at this rate. The amount of the loan required by both the firms is same at the current exchange rate. So it is always like that. A financial institution may arrange a swap. Swap means interchange. And requires 25 basis points as its commission. So 0.25% is the charges. Gain, if any, is to be shared by the firms equally. So this is very good information that they have clarified. Let's say if at all there is any gain, it will be shared by both of them in equal proportion. We are required to find out whether a swap can be arranged which may be beneficial for both of them. So any interchange is possible so that it will be beneficial for both of them. That is a question. So we can say something like this. It is very simple. There are 3 steps in which I generally suggest students to do answer. Step number 1 is that what is the total interest cost if at all they would have borrowed independently. IB will have the interest cost of 2% and Zeki will have the interest cost of 2.5 plus bank prime lending rate of interest. So if at all they would have borrowed independently, it is 4.5 plus bank prime lending rate of interest. That is the step number 1. We'll tell both of them to borrow differently. As there are 2 companies, we don't have to think much. We'll tell both of them to borrow differently. So IB will borrow at Indian INR floating rate BPLR plus 0.5%. And Zeki will borrow say at 2.25%. So what is the total interest cost? It is B plus 2.75. So when you make a comparison between both of them, you can see that so the BB is getting cancelled. The interest cost of 4.5 reduces to 2.75. So there is an advantage of 1.75. 0.25 is the advantage which the intermediary has. So net advantage is 1.5, which both of them are going to share equally. So we understand that it is going to be beneficial for both of them. So the first answer is yes. What rate of interest will firms end up paying? That is the question. So we understand that so the question says that so what is the interest cost that say they will have ultimately? It's very simple. Half of this is 0.75 and it is 0.75. So instead of 2, it has to pay interest of 1.25. Instead of B plus 2.5, we have, that is he has to pay B plus 1.75. That's it. So I would say that so this was an extremely simple question. Chalo, Prerna, but clear? Redmi 1, Parth and Vivek. Okay. Prerna. Okay. Redmi 1, just you can write your name. Okay. Prerna Bhatt and Redmi. Prerna, Redmi. Okay. Next. But this time, friends, the theory which was asked about was not the direct theory. It was like indirect theory. The question says like this. Peer-to-peer lending and crowdfunding are the same and traditional method of the funding. Do you agree? That is what the question is. We understand that the answer is no. Peer-to-peer lending and crowdfunding, both of them are different. So we are required to give a justification for that. So just be careful for these kind of new questions. Okay, thank you. Question number 3A. Now, this is again a question in which I feel that, say, from this 7 marks question, only a new point which I find is the convexity. But except that everything is the same as what we do usually. Nothing is different. Let us read. The following data are available for a security that is called a bond. Face value is 10,000 to be redeemed at par on maturity. Coupon rate is 8.5% per annum, that is rate of interest. Number of years to the maturity is 5 years. Yield to maturity is 10%. The first question is calculate the current price of the bond. That is the question. So year 1 to year 5, 10,000 into 8.5%, $850 rupees will be received, and fifth year end 10,000. It will be discounted at the rate of 8%. We'll compute the present value, and present value of the same is P0. That is the first thing. The second is Maculus duration. Means duration is required to be computed. That is also very simple. 1, 2, 3, 4, 5. 10,000 into 8.5%. So it is 850, 850, 850, 850, 10,850. Again, converting that into the present value term. And importantly, friends, be careful that, say, for the purpose of converting in the present value term, we will use just 10% as the discounting factor. And they already have provided the factors. So don't use your own discounting factor. Use the factors that, say, they have provided. Then we'll compute the proportion. This is the cash flow. Discounting at 10%. We'll compute the present value. We'll compute the proportion. Proportion into time period. We'll compute the weighted average, and that is what we understand is the duration of the security. Next, volatility of the bond. It is calculated as duration divided by 1 plus K. Volatility is indicating what would be the percentage change in the price of the security for every 1% change in the cost of capital. That is what, say, we understand is, say, indicating as far as the volatility of the security is concerned. The convexity is new point. That is absolutely a new point. I just give you a small explanation about the convexity, yet it is not required too much for solving the question, but I just want to give you a small explanation about the same. Now what happens that, say, as I just told you, that volatility is indicating what will be the percentage change in the price of the security for every 1% change in the cost of capital. So the diagram is like this. On x-axis we take the cost of capital, and on y-axis we take the P0. Now what happens that, say, we understand, actually if at all you draw the diagram, it is like this. With the increase in the cost of capital, the price reduces at a reducing rate. Means every 1% change in the cost of capital will not have the same reduction in the price. That is what, say, we understand important. So over here, this is given a name as the convex. This is given a name as convex. That difference is given a name as convex. And we are required to find over here, say, the convexity. That is what it is indicating, that, say, the basically this difference. And it is useful again for the purpose of making calculation of the price of the security, say, with the reduction in, that is, say, the change in the or increase in the required rate of return. That is what, say, we are required to find. And for that, say, we have to apply a formula like this. C star into change in the cost of capital into 100. For C star calculation, it is V plus V minus 2V0 divided by 2V0 into square of cost of capital. What is V plus? It is indicating the price of the security if the required rate of return is falling down. What is V minus? Price of the security if the cost of capital increases. So taking 8%, which is given to us as an example, we have computed the revised price. Since we have taken 2% reduction, similarly we will take 2% increase. And that is the way we compute the two prices. Minus 2V0 means the price of the equity share, say taking 10% discounting rate, by 2V0 into change in the cost of capital raised to 2. What is the change in the cost of capital? 2%. 10, from that it reduces to 8, and from 10 it increases to 12. That is the reason over here set is 0.0. Once we find C star, afterwards you can see the formula is C star into change in the cost of capital square into 100. So this is the C star into change in the cost of capital raised to 2 into 100, that is 0.395%. This is the way it is calculated. Yeah. Everybody is clear? Just give a thumb to me. Everybody just give a thumb to me. Okay. Thank you, Prerna. Parth, Vivek, Shivani. Parth, Vivek, Shivani. Okay, thank you. Fifth part of the question is again very simple. Expected market price if there is a reduction in the cost of capital by 2%, means the required rate of return reduces from 10 to 8 by two methods. One is the modified duration method and another is the present value method. So in modified duration method, what we will do, revised price is equal to current price plus current price into volatility into 2. Why into 2? Because there is a reduction in the cost of capital by 2%. And by intrinsic value method, we already have done it. And over here we add, why? Because the cost of capital reduces. We would have deducted it if at all there is an increase in the cost of capital. This is the way we are required to calculate the answer. Now friends, question number 4 is a question which is very similar to one of the questions that they have provided in revisionary test paper of November 2011, question number 8. It is very similar to that question. A simple question, but at the same time, I agree that if at all a student has not done it, then during examination condition, it was really difficult for the student to solve. I would admit that so honestly, from my end, a student like me will definitely face a difficulty unless I have done it say before once, that is say before examination. And friends, so this is a question which they have taken from a reference book called I. M. Pandey. An author of I. M. Pandey sir, from his reference book, say this question is taken. ICL is proposing to take over SVL. So this is acquiring company and this is target company, with an objective to diversify. For the purpose of diversification, the profit after taxes of the acquiring company has grown at the rate of 18% per annum. So growth rate is given 18%. And SVL's profit after taxes is growing at 15%. This is 15%. Both the companies pay dividend regularly. So both the companies are paying regular dividend. The summarized P&L account for both the companies are given. So P&L information is given. In that, so the sales is given, operating income is given, interest is given, profit is given. So tax provision, profit is given, and dividend information is given. Then of course the balance sheet information is there. Fixed asset, land building, plant machinery, furniture, current assets, less current liabilities, creditors, OD, tax provision, proposed dividend, net assets. Then liability side further, paid up share capital, reserves, borrowing, capital employed. Market price of the equity share is given. ICS land and building are stated at the current prices. SPL's land and building were revalued 3 years ago. So before 3 years it was revalued. There has been 30% increase per year in the value of the land and building. So there is an increase in the value of the land and building at the rate of 30% for 3 years. SPL is expected to grow at the rate of 18% each year after the merger. So post merger, the growth rate will increase to 18%. ICS management wants to determine premium over the share over the current market price, which can be paid on acquisition of SVL. So we have been given that, so this is the market price. So what amount of the premium that can be paid? That is a question. You are required to determine the premium using first method, premium using the second method. The first method is net worth adjusted for 1. Current value of the land and building plus estimated profit after taxes for the next 5 years. Second is the dividend growth formula. Third is ICL will push forward which method for the purpose of negotiation. So between these two, which method ICL will recommend for the purpose of acquisition? That is a question. For the time period 1 to 5, future value factor is given at the rate of 30% and at the rate of 15%. 12 marks question. Really a very big question. So basically over here, first of all, we are required to understand that, say, this is a question about the valuation of the entity for the purpose of acquisition. So entire focus is on the target company. Let us go simply with the information of the question. The first is provided to us net worth. What is the net worth? The net worth is 780. Okay. Paid up share capital plus reserves and surplus. Simple. Adjusted for current value of the land building. Land and building of the target company was 190 crore. Yes. There is an increase of 30% per year in the value of the land and building. And it was revalued 3 years ago. So we can say that plus, listen carefully, (1.30 raised to 3 minus 1). So this will give us appreciation into 190. Everybody is clear with the what I have written? Parth, Prerna, Vivek. Parth, Prerna, Vivek. Okay. Yeah, thank you. Yeah, can you please explain? Yes, Parth. Parth, over here it has been given that there is 30% increase every year. So 190 into 1.30 raised to 3. This is the current value. From that 190 is deducted. So we'll get the appreciation. Because value of the 190 is already included in this 785 indirectly. Part clear? Okay. Plus estimated average profit after taxes for the next 5 years. We have been provided with the information that as far as the target company is concerned, its profit after taxes is given for the recent year 250. And the question says it's a plus estimated average profit after taxes for the next 5 years. We have been provided with the future value factor at 15%. For 5 years, it is 7.7537. So over here, 215 into 7.7537 whole divided by 5, because we have to take average. Instead of this, a student can make working like this: year 1, year 2, year 3, year 4, year 5. For year 1, it is 250 into 1.15 raised to 1, raised to 2, raised to 3, raised to 4, raised to 5. You compute the total and then you divide by 5. You'll get the same answer. Is that clear? Just give a thumb to me. Anybody wants me to explain again? Okay. Thank you. So now we have got, say, this valuation. This is the total value of the company. This is the total value of the company. That divided by the number of shares will give the price per share. And whatever the price per share that we compute, from that, say, this 75 will be deducted, and with that, say, we'll get the premium amount. This is the first method of doing answer. Sorry, answer of the first method. Okay. The second method, dividend growth formula. So how to do answer in dividend growth formula? Let us see. P0 is equal to B1 divided by K minus C. It has been, that is provided to us very clearly. Let's say the growth rate of the target company post merger will be 18%. So this is 0.18. We have been provided with the information about the dividend. It is 125 crore. So 125 crore divided by 10. So it is 12.5 crore. That is the number of shares. So 125 crore divided by 12.5 crore. So that comes to 10 rupees per share. That is the D0 information is given to us. So 10 into 1.18. That is the D1. What is K? K is required to be found using the existing information. It is D1 divided by P0 plus D. So 10 into 1.15 divided by 75 plus 0.15. That is the way the cost of equity can be found. So this is the cost of equity that we have right now. Keeping this cost of equity common, and we'll compute the P0. These are the two steps in which we have to do answer. Anybody wants me to explain again? Prerna, Saloni, Parth, Vivek. Just give a thumb to me. Okay. Vivek, thank you. Saloni and Prerna. तो फ्रेंड्स आप देख सकते हो कि सिर्फ अपने को ये दो मेथड ही करने का है. We don't have to do anything else. This and this, and you'll get 12 marks. Just imagine. And which method the acquiring company will push forward? The method in which it has the lower valuation. That is what we understand. Let us see the next question. This question is extremely simple. Vivek Rana says that, sir, Vivek, this factor will be used 2.197. Yes, this 2.197. Okay, Vivek. Yeah. So let us see. US dollar 10,000 is lying idle in your bank account. You're able to get the following quotations from the dealer. We have been provided with exchange rates. So we have been provided 1.2752 dollar per UK pound. Then 0.9094 pound per euro. 1.1539 dollar per euro. Like that information is clear. Is there an opportunity of the gain? That is a question. So for that is what happens, friends. You are required to keep any one of the three exchange rate common, and you have to find the cross currency for the remaining two. Suppose I keep this as common, and I find cross currency for this two. There are a number of methods by which you can do the cross currency. 0.9094 pound per euro. 1.2752 dollar per pound. These are the two rates. We'll compute the dollar per euro in order to make it comparable. So for 1 euro, how much dollar is the question? So the dollar will be the final answer. Answer is required per euro. Against euro, which currency is given? Against euro, pound is given. Against pound, which currency is given? Dollar is given. So I want dollar per pound, 1.2752. I want pound per euro, 0.9094 into 1. So the answer comes to 1.1597. That is dollar per euro. That is exchange rate. So we can see that both of them are not matching, so arbitrage exists. Yes. Anybody having doubt till this point of time? Okay. So now what we will do, friends, we can make the arbitrage like this. Sale dollar, purchase euro. Then sell euro, purchase pound. And sell pound, purchase dollar. That is the simple sequence in which, say, we have to do answer. Just a minute, I come to your question, Vivek, just a minute. Okay, sell dollar means $10,000. Now against dollar, euro is given. So 10,000 upon 1.1539. So 8,666.26. This is the euro. So against euro, you will get the pound. So it is 0.9094 into 8,666.26. So 7881 7881.10 pound. 7881.10 pound. And against pound you'll get $1.2752 into 7881.10. That is $10,049.98. So what amount you receive is 10,049, which is more by 49.98. And there is a question, sir, whenever there is a rate given like this, do we need to take same rate or we need to apply logic? हाँ विवेक अपने को लॉजिक लगाना पड़ेगा यार. विवेक लॉजिक लगाएंगे हम लोग. ओके विवेक is that fine? Vivek yeah. विवेक लॉजिक लगाएंगे. See what happens at the pound is expensive than dollar. So it is dollar per pound. Okay. I agree with your point. Next question. Yes, $1.2752 per pound. Okay. Question number 5. ICL and MNC is executing a plant in Sri Lanka. It has raised an amount of rupees 400 billion. Half of this amount will be required after 6 months. So only half amount is required, half amount will be required afterwards. ICL is looking an opportunity to invest this amount on April 1st, 2020 for a period of 6 months. So for a period of 6 months, you want to make investment. It is considering the two proposals. Invest in Japanese yen or invest in United States dollar. Nature of the investment, index futures, so index fund and the treasury bill. Means you will purchase such investments which replicate the index fund. That is what it says. You will receive the dividend income 25 billion, of course in Japanese yen term. Income from the stock lending, again in billion term, 11.9276. Discount means the price reduction on initial investment at the end of the period, 2%. Interest rate 5% in case of the United States Treasury bill, that is government security. Exchange rate is provided to us between rupee and like the Japanese yen currency, and again say rupee and dollar currency. Exchange rate after like 6 months is provided to us, again between these two currencies. You as an investment manager is required to suggest the best course of the option, that is option. Again friends, this is a similar question which have been asked by the institute earlier in examination. Very similar to this. Not at all any change. So what happens, let's say we are required to make the conversion of say this into We have 400 billion, but only half is excess. So 200 will be converted into Japanese yen. So if at all you invest in yen currency, what will happen? 1.58 yen for every one rupee. So 1.58 into 200. This is the amount that you will have in dollar currency as invested. That is 360 billion. This is what you will invest. You will receive the dividend income 25 plus you will receive the income from stock lending 11.9276. Discount means the price will be reduced by 2%. So 309.68. So this is what you will have at the end of the 6 months. 25 plus 11.9276 plus 309.68. So 346.6076. This is what you'll have. And this is of course in the yen currency. That will be converted into the rupee currency. And for that, say this is the forward exchange rate that will be used. Divided by 1.57. So 220.769. This is what we understand. Just give a thumb to me if at all you are clear. Yeah, thank you. Parth Joshi and Prerna Bhatt. Okay, thank you. So here, this is what we have in case of yen currency. The another is that say you invest in dollar currency. The exchange rate is provided to us as 0.014. So it is 200 billion into 0.014. So $2.8 billion. This is the amount that say you will have say in form of investment. The rate of interest is provided to us as 5%. $2.8 into 5% into 6 divided by 12. 0.087. So 2.87. And this is the forward exchange rate at which you will do the conversion. Simple. So it is 220.769. Coincidentally, in both of them, answer is coming same. So in terms of the return, you are indifferent. So whether you are going for the first option or you are going in the second option. The question says that say you are required to answer which is the better course. Better course is that say from a risk point of view, we understand that when you invest in the treasury bill, the risk will be less. So the treasury bill would be better. Next question. The following are the details of the three mutual fund MFL. Growth fund is given, balance fund is given, regular fund is given, and market portfolio information is given. Return is provided to us of each of the fund. Variance is given to us. coefficient of determination is given, that is R square is given to us. The yield on the 182 days treasury bill is 9% per annum. Means 9% is the per annum rate of interest. You are required to rank the portfolio using the Sharpe method. Okay. Now using the Sharpe method means Sharpe ratio is required to be found. How to find it? X bar minus RF divided by standard deviation. So over here 7, 6 and 5. 7, 6 and 5. What is RF? RF is 9. So minus 9, minus 9, minus 9. Divided by standard deviation. This is variance. So standard deviation is under root of 92.16. Standard deviation is under root of 54.76. Standard deviation is under root of 40.96. Of course, friends, the numerator is negative, so the answers are going to be negative. Because 7 is less than 9, 6 is less than 9, 5 is less than 9. Then using the trainer's method. In trainer's method, we understand that so the beta information is required. So we'll compute the beta first of all. Calculation of the beta is very simple. R into standard deviation of security upon standard deviation of market. This is R square. So what is R? Square root of 0.3025. What is standard deviation? Square root of 0.9216. And what is the standard deviation of the market? It is square root of 57.76. So what happens? Let's say we are required to do square root of everyone. So it is 0.3025, 0.9216, 57.76 under root of the C. We'll compute the beta. Then again the same formula. However, in the division, instead of standard deviation, we'll keep the beta. This is what we understand. So very simple calculation. The only surprising point is that say all of them are having negative. So rank is lowest negative will be given the first rank and so on. This is the way we are required to do answer. Compare the portfolio with the market. The market return is 9 and RF is also 9. So of course for the market both the ratios would be 0, 0 because 9 minus 9 and 0 is more than negative. So they are not able to beat the market performance. That is the answer. Honestly, my personal opinion is if at all the ratios are negative, then in that case, you don't have to invest in that security. Giving ranking for the negative is something I do not able to digest. Fine. This is what they have provided answer. Six A is again a question which has been asked frequently in examination. Frequently. Not less than for 5 times, say they would have asked this kind of question in examination. In my opinion, very simple question. My personal opinion. An investor is considering to buy the equity shares of a company whose current market price is 112. So P0 is given. The company is proposing a dividend of ₹4 next year. So year 1 and dividend per share is 4. LX Limited is expected to grow at 20% per annum for the next 4 years. So for second year, third year and fourth year. 4 into 1.2. 4 into 1.2 raised to 2. 4 into 1.2 raised to 3. The growth rate will decline linearly to 16% after first 4 years. Means growth will be there, but the growth rate will be linearly decreasing to 16%. So 1.2, 1.2, 1.2 into 4. That comes to 6 rupees 91 paise. Fifth year dividend will be 6 rupees 91 paise into 1.19. So 6.91 into 1.19. So this 8.22. Then 8.22 into 1.18. Seventh year, it will increase 1.17. Then 8th year onwards, it will increase at the rate of 16% for perpetuity. Like that information is given. Thereafter, will stabilize at 16% per annum indefinitely. Investor requires a return of 20% per annum. Cost of capital is 20%. Calculate the intrinsic value of the share. Means present value of the future cash flow is P0. Whatever the answer that we get in the first part of the question, that we have to compare with the 112. If the present value of the cash inflow is exceeding 112, then in that case, we understand that the security should be purchased, not otherwise. Yes, Vivek says correctly. That's why we can skip this question. Just a minute, I want to drink water. Now friends, again this is a question from like the chapter of capital budgeting of the IPCC, that is adjusted present value concept. Let us discuss that. The management of a multinational company is engaged in construction of the infrastructure project. A proposal to construct a toll road in Nepal under construction of the management. The following information is available. The initial investment will be the purchase price of the equipment of $250 lakhs. The economic life is 10 years. The depreciation will be charged on the S&M basis. So 250 lakhs divided by 10, 25 lakhs. Earning before interest, depreciation, tax, amortization to be collected from the toll road is expected to be 33 lakhs per annum for a period of 20 years. So year 1 to year 10 and year 11 to year 20. Earning before interest, tax, depreciation is 33. Less depreciation, 25, 0. So earning before interest and taxes, that is 8 and 33. To encourage the investment, Nepalese government is offering 15 years term loan of 150 lakhs United States dollar at an interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of the 15 years in one tranche. So repayment at the end of the one stroke only at the end of 15th year. Cost of capital is given to us. For all equity financing is 12%. That is, if at all the weight of equity is 1, then cost of equity is 12%. Post-tax cost of debt is 5.6%. Income tax rate is 30%. So 5.6 divided by 0.7. Pre-tax cost will be 8%. All cash flows will be in dollar currency. Ignore inflation. You are required to advise the management on the viability of the project by using the NPV, that is APV concept, adjusted present value. Annuity factor is given for 10 years, 5.65, for 20 years, 7.469, 8% for 15 years, 8.559, 8% for 15th year is 315. Now friends, as far as the APB concept is concerned, it works like this. Listen carefully. APB concept says that, say, first of all, we are calculating the base NPV. It means that, say, what is the NPV of the project? If at all 100% of the project is financed with the equity financing only, that is called base NPV. Then we will see that, say, we have raised the debt financing. So in that case, we will get the interest tax advantage. So present value of the interest tax saving will be helpful the company to increase the NPV. So present value of the interest tax saving discounted at the pre-tax cost of debt financing will be added to the base NPV to calculate the adjusted present value. That is the way we are required to calculate the answer. So there are three things. First is calculation of the base NPV, assuming that, say, there is 100% equity financing. Second, calculation of the present value of the interest tax saving. And third, calculation of the APV. So in the first case, when we assume that, say, there is 100% equity financing, we will not deduct the interest. So earning before interest and after taxes, that is 8 into 0.7, that is 5.6. 33 into 0.7, that is 23.1. Depreciation is a non-cash item. 25 and 0. So cash flow after taxes before interest, 5.6 plus 25, that is 30.6. And this is 23.1. This is how we will make the calculation of the cash flows. Cash flow after taxes and before interest. Then base NPV. Year 1 to year 10, year 11 to year 20. Cash flows. 30.6, 23.1. Discounting at the rate of 12%. Present value. That is present value of the cash inflow. Taking investment 250, we make the calculation of NPV, and that is given a name as base NPV. That is the way the first working is required to be made. Then we will make the calculation of pre-tax cost of debt. It is post-tax KD divided by 1 minus T. We have to make it pre-tax. So 5.6 divided by 1 minus 0.3. So 5.6 divided by 0.7. That comes to 8%. Then whatever the base NPV that we have plus interest into tax rate, that is interest tax saving into PVIFA at the rate of 8% for how many years? For 15 years. With that said, the APV is calculated. Okay. Yes, anything else? Okay, thank you. Friends, I think that say we can close the session right now, and whatever the doubt or query that you have, you can definitely pass on that to me at any point of time. I'll be happy to solve it. This is my phone number. Along with that, I have sent the material also to you. You can WhatsApp any of the question or query to me. Okay. Wish you all the best for examination. Thank you.
For coming today and taking our session. I'm Khushi from Vikas Ahmedabad.
Yes. Thank you, Kushi.